What's up everybody, welcome back to AZ Trading, hope you're all doing well. It's a brand new week and on the first London session of the week, we've managed to capture a really nice long entry right over here. And not only that, our long entry, we've been holding it and taking partials along the way, and we've captured almost 420 points so far on the Dow Jones, which is the US 30. So definitely stick around if you'd like to know exactly what my analysis was prior to the entry and the strategy that we used to capture this move and how you can capture moves like this one in the future. Don't worry guys, no hindsight reviews here. I can turn on my orders, executions, and the positions as well, where you can see my entry, where I took off a few partials along the way, and where I've got 10% of my position to run, which we will be aiming at these higher time frame equal highs with our stop loss trail to break even. This will be a pretty interesting video, and I'll be talking about the DXY, the dollar index, and how looking at this asset class made this bullish trade idea a very high probability setup. So I've just zoomed into a 1 minute chart, and we'll first go through the RMR strategy, which is how we found this entry, and afterwards I'll talk about the daily bias. So why did I choose to be bullish for the day? And a large reason for that is because of the dollar index, and then I'll briefly also mention the market sentiment, which is also another reason that helped us frame this trade. So if you've watched any of my previous videos, you're pretty familiar with the RMR pattern, where first we look for a raid, and if we have a look at price during the London Open, we have some relative equal lows over here, and as soon as price reaches through that area, this is what we can call the raid. After the raid, the next thing we look for is the market structure shift. So we've had a bearish raid, next thing we look for is a bullish market structure shift. So as soon as swing highs become broken, so these swing highs over here, as soon as these ones are broken, this is called the market structure shift. So price is now bullish. And after the market structure shift, we wait for a return area, and this is where we will participate in the trade. So as price is traveling and creates the market structure shift, we're waiting for a specific area for price to retrace into before we can place our long. The reason for this is because during this market structure shift leg, during this bullish leg, a lot of retail traders will be FOMOing and chasing price. So they'll be longing and placing buy orders, but we don't want to chase price, and we want price to chase our entry position, which is our return area. Because if you're chasing price, you'll never be able to find precise entries. So what do we look for in the return area? We can look for a gap, which is the most obvious one to see, which is over here. If I extend that one all the way to the right, you can see that price has retraced into that area and filled it completely in the next leg. And once price does that, that's where you can place your long. Whether you decide to long at the top of the gap, in the middle, or at the bottom when the gap's completely filled, that will be completely up to your own trading entry framework, depending on how optimistic or how great you want your price to be. So if you're happy with a fair price, you can place your entry as soon as you reach that gap. And if you want a slightly better entry, you could wait for the entire gap to be filled before entering, which is what I did. And furthermore, if you wanted a very, very excellent price, you could wait for price to retrace into this bottom gap down here before placing your long entry. However, you can see that this is a great example that shows that the more optimistic your entry position is, or the better you want your entry price to be, the less likely it is for price to reach that area. And once you've placed your entry, the first thing to set is your stop loss, which in most cases will be at the bottom of the raid, which is down here. And now we can start to look for objectives above. Alright, so this is the exact pattern that I used to find this entry. But before I move on to the objectives, I'll just talk about the daily bias, which will explain why was I looking for long positions, because we could also argue that above these equal highs we can call the raid. After it breaks a swing low, we can call this the market structure shift. And then we have a gap over here. Why didn't I place a short here with my stop loss at the raid's high and objectives below? You can see that this short RMR, this short example, would have been stopped, but we can clearly see that it still follows the pattern. So why did I not take this trade, and why did I take a bullish trade? I forgot to mention, just really quickly, in this return area, we're on a 1 minute chart where we can see a gap quite clearly. However, on the 3 minute chart, the gap is smaller over here. It's not as extended. And on the 5 minute chart, you can see the gap is much smaller and above, and it doesn't give as optimistic of entries compared with the 1 minute. So I've seen a few questions where you ask which time frame should I use. There isn't one single time frame that's better than the other. You just have to keep switching back and forth until you can find the time frame that shows the cleanest price action. So in here, the 1 minute chart shows the cleanest return gap. Alright, so back to daily bias. Since our bias is driven a lot by liquidity, if you imagine at the start of the day, we're over here, we'll be doing a liquidity analysis, so having a look above the market and having a look below the market and seeing which side has more liquidity, is closer, and which is a more likely objective. So if we have a look below, we have this previous day low, we have this big gap down here, and we have this big daily equal low over here. And if we have a look above, we have some swing highs, we have this gap above this swing high, and we have this hourly equal high right above. And in my eyes, the gap up here and those equal highs over here were much closer and a much more likely objective than the equal lows down here. But this wasn't the only reason why I decided to be bullish. A strong factor in this decision was looking at the DXY. So if you don't know already, DXY is the dollar index, and the dollar index moves inverse towards indices. So if the indices are going up, then we can expect the dollar to be bearish. So prior to our entry, which was around 430, I've just drawn a line at 430 on the DXY, so just before our entry. And is there anything obvious that you can see? Any areas of liquidity? So equal highs, equal lows. Is there any area that's very obvious? And if you see what I'm seeing, of course, it's these relative equal lows on the dollar index, which I'd argue is incredibly clean. So it would be a very likely objective, because under resting equal lows, we know there's a lot of liquidity. A lot of retail traders see this as a strong area of support. Since it's bounced so many times, they're now trusting this area so much. So when it gets down there again, they're going to trust it and buy and buy and buy. But little do they know, underneath is liquidity, which means it's a likely objective for price to reach. So with just that being said, if we can anticipate the dollar index being bearish to take out those lows, what does that mean for the indices? It means for the indices, we're more likely to be bullish since they are inverse. Does that make sense? Alright, so when we combine our bias of being bullish because of those equal highs above, as well as the dollar index having equal lows below, this is why you can see we decided to filter out this bearish trade and to focus on this bullish trade. Alright, let's move on to sentiment pretty quickly. And if we have a look at how price is reacting from the week's open, I would say that price is quite obviously bullish since highs are constantly being taken out and all these lows are being left untouched. So we've determined the sentiment to be bullish, so most retail traders are placing longs since they're trend following, and as they're placing these longs, they'll be trailing their stop loss to protect their position at all the recent swing lows. So this swing low, that's where they'll be protecting their position. And so if we have a good idea of where the retail traders' stop losses are, we can anticipate a break in structure to break the sentiment before it continues for its real move. And as you can see where we outlined the initial raid, this is where the market broke sentiment, stopping out all the retail traders that are going long before it paints an RMR pattern, which gave us an opportunity to participate after taking out the retail traders. And if you're wondering why did I choose to long the US 30 and not the S&P or the NAS, just really quickly, if we're looking for a bullish trade, we want to find the strongest of the three. And if I just draw a fib from the bottom of this big swing to the top of that swing, you can see that the Dow retraced above the 50% level, the S&P retraced below the 50% level, and the Nasdaq also retraced much below the 50% level. And that's why I decided to long the Dow. Alright, let's move on to our objectives, which is the fun part. So if you have a look at my very first partial, which was around 70 points away, you might be confused what I saw that led me to take off this partial. And no, it's not this swing high, and no, it's not this little gap in here. But if you have a look at what time that partial was taken, it was at 5:15. And if we have a look at the DXY, if you remember, we were aiming for those equal lows. And right when DXY decided to dump, right when it touched those equal lows, you can see what time it was 5:15. So this is another way you can take partials, because usually I always mention that I take it at areas of liquidity, so different swings and areas with gaps. However, in this one, we took it off when we timed it with a correlating market, so when the DXY reached an area of liquidity. Okay, moving on. The next one is quite simple. At this swing high, I took off my next partial. Just zoomed out to a 15-minute chart, and you can see that there's a gap over here. As soon as price filled this gap, that's where I took off my next partial, and you already know what's happening. I've reduced my stop loss to break even, and I've left my final partial to run to these daily equal highs. So whether price ends up pumping to the moon or stops me out at my break even level, I'm impartial to whatever happens. So overall, this is the trade, guys. And if you'd like to outline this RMR pattern yourselves, I'll just turn off all my annotations so you can take a screenshot of the naked chart and outline it yourselves for practice. But that'll be it for this video, guys. I just want to mention on my YouTube community tab, I've put out a little poll for you guys to vote which day you'd like me to do a live stream. So far it seems Thursday the 20th I'll be live streaming, and most likely I'll be starting in the middle or the end of the London Open so we can watch price live and we can see the New York Equity Open together. I feel like my thoughts during that time can be helpful with your learning. Alright guys, if you enjoyed this video or learned something new, don't forget to hit that like button and subscribe. It makes me very happy. And if you've got any questions or comments, leave them down below. I don't get a million comments, so I'll be able to get back to every single one of you. But until next time, take care everyone. Peace.